It straight up says on like page 1 of the book that this is not about investments of any kind.
Why would I pay money to borrow against my cash value? Because I can control it.
You don't have to be wealthy to save $400 a month. You just have to be willing to save some money.
Guys, what are we even doing talking about whole life insurance if we could get hundreds of thousands - millions of coverage / tax-free income? All right, hey everybody, welcome back to Remnant Finance. It is almost the end of January now. We are back for another one. We're going to be doing a walkthrough of Brian's recent video on his new channel. Brian's got a great new channel out that's going to be a lot more shorter clips and content that answers a lot of IBC specific questions rather than the podcast page. So if you haven't already, look up at Brian R. Moody on YouTube, or just look up, you can search Brian Moody IBC scam, and that'll take you to his first video. That's the video we're going to talk through today. But Brian, tell us a little more about this channel that you got going on.
Yeah, so this obviously these podcasts end up going, an hour most of the time. They're long form video. We get into side discussions. So I decided just to have a punchier, the first three, probably 10-minute-ish is the target range for these videos to kind of just answer and educate on one specific thing about IBC at a time. And ultimately, hopefully to have a library of hundreds and hundreds of videos that becomes a go-to source. And at some point, I'm sure they'll get longer, when I earn that right on that place on YouTube, to maybe have a guest here and there and have longer form discussions. But the first three videos, they're like 17, 18 minutes each. I was just having a hard time whittle those early ones down of what is IBC? It's back to the 101 stuff. Is this a scam? Kind of like a 30,000 foot overview of how you can use a policy drawn out on a whiteboard. But yeah, going forward, I'm trying to get them down definitely inside 12 minutes. And even this one, this one was about 18 minutes on the podcast, or I'm sorry, on the YouTube channel, but we could easily probably spend some time talking about it more in depth. I was just hitting the highlights over there, but really excited about it. I already have a basic whole life mechanics, like how everything works inside the policy, how everything functions, how you use it, why we think about things, why we structure things. So I'm going to create an entire playlist on that rather than continuing to send our clients to other people's content for those sorts of questions. So really excited about it, man. I think it's going to be awesome as kind of like a secondary video audio source that isn't such long form content, because that can get hard to listen to depending on your time and what you're doing. Or if you just want one question answered, you might not want to listen to, scour through our 100-some episodes now to find a 10-minute segment out of an hour. Like, it'll be a lot easier. Just type the question in, bing bong, there's the answer.
Yeah, and so we'll have a link to sign up for Brian's. So you're going to have two different channels, obviously, that we're supporting. We hope you subscribe to both. It helps us out. But maybe, if you check in, you get our weekly email, you listen to the podcast. That's a once a week kind of thing. But if, for more of like daily content that you're looking for, just the snippets, like Brian said, check out his channel there. Again, link will be in the bottom, and request you subscribe to both. So the first one we're going to do is the first video that Brian put out. And this is going to sound familiar. If you've listened to us from beginning to end, you're not going to hear a single new thing today, most likely. But we've got a lot of new listeners, and we're getting a lot more traction. And so a lot of you probably haven't gone back to episode 1. If you heard about us in the last few months, maybe you heard about us with low stress options. Maybe you heard about us through Tax Sherpa, or some of the Joe Withrow, Phoenician League, some of the people that we've interviewed, people in our sphere. If you've jumped in, you probably haven't gone back to episode 1. We hope you do, because we think there's a lot of value in the content. But a lot of this is going to be repeat. We're going to talk through. Brian's got a list of some of the biggest objections to IBC that we hear, and then so Brian's going to kind of drive it and go one by one through what he addressed in his video. Again, that first video on his new YouTube page, and then we'll just have a longer conversation about that. So, all right, Brian, what do we got?
Yeah, and speaking of that YouTube video, if you're a listener to this podcast, I would love it if you would go there. It's at Brian R. Moody, or like Han said, just look up Brian Moody IBC scam. It would really help us get some traction for Remnant Finance if you could subscribe. Actually watch them, even if you go to 2x speed. For our regular listeners here who might do this favor and watch the duration of the video, please don't just open it and close it in 1 minute. Because especially early on, in a year from now when there's some traction, that's fine. But when a brand new channel comes out on YouTube or in podcasts, like duration and search for those things is a huge help to us. So we'd really appreciate it if you'd subscribe and watch that stuff.
Yeah, one more quick note on that. We don't get until you reach a certain level. Like there's so much behind the scenes that Brian knows a lot, is a lot better versed in the YouTube stuff. I hate all of that, but I have to learn. And there are metrics that you have to hit before you can monetize. And the reason we're concerned about that is not because we're trying, not like trying to get paid to place ads, but because ads are being put on our videos already outside of our control. And what I've noticed lately is we've got all the view hours we need. We've got a lot of view hours. We don't have as many subscribers, which is why we're pushing to get more subscribers. But because we have a lot of view hours, we're starting to get ads assigned to our videos, but we don't have any control over those. We can't remove them. And I think the reason our intro music is licensed and paid for. We purchased that and own the rights to it. But there's some miscommunication or disconnect there to where because of that getting flagged, I don't know if it's by the producer of the video or how that works, but basically we're getting flagged for having copyright violation for music that we own, and we don't have control over what goes into the ads. And so when I've put it on, and I'll just for the same reason Brian's talking about, I'll throw it on my YouTube, even though of course I've heard it, we did it. I'll throw it on YouTube just to add a play on there, and then it'll go with like 4 ads. And if I don't hit the skip button, if I'm not paying attention, it's like a 40-minute ad, which I don't see on any other
40
channels that I watch.
or 0?
Yes, it's like an infomercial ad. It's crazy.
Holy
And so
smokes.
it's
Yeah.
not every time I do a video, but I have noticed it where I'll play it, I'll do something, I'll come back and look at it, and it's not playing our video, it's playing an ad. And there's the button to skip, after 6 seconds or whatever, you can hit skip. If I don't actively hit that skip, it's these long infomercials. And so I don't want that for you, and I want to be able to remove that, but we don't really have much control over that until we get to certain points. And so we are pushing hard to try to get there so that we don't have to hit, that they're not forcing you to listen through all of this absurd amount of ads. And so anyway, so that all helps.
And not just that, like the personal YouTube channel, or not personal, but the one that I'm doing now with these shorter videos, it is so far from being monetized. I'm not even thinking about that. I just want to get our word out there for people like us that would benefit. And it would be the more that our people who are already in our ecosystem subscribe, listen, and help us out on that, the more it gets promoted to similar people out there just organically. But anyway, let's go to this. We're already 7 minutes into this without talking about the topic. So is infinite banking a scam? And what I did was in the YouTube videos, I kind of just went through the top 10 objections, and I kind of hit the bullet points to keep it shorter. So we'll talk a little bit more on each one. So the number one objection that comes out: whole life is a terrible investment.
Correct. Yeah.
It's all right.
Yes.
Let's go to number 2.
Yeah.
Oh yeah.
My high yield savings account is also a terrible investment. Like if you have term life, that's a terrible investment. Your
Standard
car
savings
is a
account.
terrible investment, right? The home that I'm renting is a terrible investment, right? There are assets. There's a whole range of asset classes, and one of them is investments. And under that umbrella, there are many different assets under the umbrella of investing. Life insurance does not fall under that umbrella, just like your car doesn't, just like your primary home doesn't necessarily. I mean, I don't think your primary home is an investment. It is an asset though. And so, yeah, it's not an investment. It's not intended to be. We don't pitch it as such. It has incredible performance metrics when understood properly and when structured properly that allow you to basically access a lot of cheat codes in the tax code, in the efficient, like all of these things we talk about. It has a phenomenal suite of benefits across the board that you really can't find anywhere else. But again, it does not live under the umbrella of investment. So if you start with that comparison, that's like saying, why would I buy a car when I could invest in my 401k? It's like a nonsense. There's a non sequitur that shouldn't need any explanation. Like you said, the right response is just to go on, but it's so prevalent. And so just, I'm going to pull up a YouTube comment just while you're answering, because I think that it's perfect.
Well, and here's the thing, like we're always talking about structuring infinite banking for the whole life, or excuse me, for the infinite banking concept. So whole life for the infinite banking concept. Infinite banking It straight up says on like page 1 of the book that this is not about investments of any kind. Although the whole idea is to recapture the interest that one is paying to banks and finance companies for the major items that we need during a lifetime, such as automobiles, major appliances, education, homes, investment opportunities. So we're looking at financing when we talk about whole life. So if besides it says somewhere in here, and I didn't look it up, it's not an investment product. It later in the same section says infinite banking, becoming your own banker, infinite banking, which does use whole life insurance. And that's another thing we could talk about. It pisses me off sometimes when I hear certain marketers out there that are like, you don't need whole life to do infinite banking. Like when Nelson wrote this book, they were kind of one and the same. He didn't say like it's just one of the places to do it. He was like no, this is whole life insurance. Like they're so intertwined. I don't think they can be separated personally. However, back to what we were saying, yeah, it's not an investment. It's a savings strategy. It's a savings vehicle. It's life insurance, and it can serve this other function, but one of them is not chasing a rate of return. That is so true. It's not an investment strategy. It's not. It is a terrible investment because I am not at no point am I saying what's the average rate of return? Can I retire on this? And although the answer to both of those is pretty good and potentially, um, so this is not an investment. There's no risk, and that's the thing neither one of us mentioned. Every investment entails risk. If it's an investment, it's something you can lose money on. Can you lose money in your whole life insurance policy? No.
Yeah, no, you
It can't.
cannot. It's
Oh,
not.
okay.
Yeah.
I didn't know if you were with me. Yeah, no, it can't go backwards. So it's not an investment at all. It's a savings. Is this
Yeah.
from our comments, like from an old video?
Yeah, this is a comment. I can't basically the it was on a short, and so the guy said, give me, tell me why whole life is better than a Roth IRA, and I'll give you all the reasons it isn't. And I was like, that's a non that doesn't make sense. Like I feel like it's a very easy, like of all the assets out there, a Roth IRA is one of the easiest ones to understand. It's just a tax code section, just like all of these things. It's just a tax treatment. That's it. Just a tax treatment. I can't say it enough. This is not this like, complicated special strategy or anything, a Roth IRA. It's just a section of the tax code. And I'm one of those weird people who's read the tax code pretty much front to back. And a Roth IRA is not a hard one to understand. So I understand a Roth IRA inside and out. Guy who's telling me that I'll tell you why a Roth IRA is better than whole life. Well, it's different than whole life for sure, and it has some great features. Like if I'm going to be in a qualified plan, I really like the Roth IRA. I really like some features. I really don't like some features. It's not an inherent good. It's not an inherent bad. It is a valuable tool. I think overemphasized, and so if we come across harsh against it, it's because it's way overemphasized in its value and utility. But I definitely get it. I know it inside and out. You're not going to teach me anything new about the Roth IRA that I don't already know. But clearly, you know very little about life insurance if you're making that comment, because you're making this like right off the bat. Again, the reason this is the first one is because it's such a prevalent misunderstanding just to even say how we can compare these things. Tell me why whole life is better than a Roth IRA, and I'll tell you all the reasons it isn't. That's a stupid thing to say. That's a very stupid thing to say that confidently. It's like most people don't understand whole life to the degree that we do. Our clients understand it better than most of these commenters. But to be so confident and say something right off the bat with start to open with such a stupid comment, like it's so prevalent. And that's why it's the first one. But to sum it up, it is an asset. It has a lot of valuable features. There are and if we list all of the things you want in any financial asset, blurring the lines between investing and saving, we could list probably 20 different characteristics. I'd say that if each asset that you listed, you got to like circle all the ones that it comprised, I would say whole life would have the largest net of all of these things. It would include some of the traits of an investment that you want, like guaranteed growth, like large compounds, like dividend, right? Uninterrupted, all these things that you want your investment to do. It does. Now, not as an investment, as a savings vehicle, but that is the most important one to hammer again. It is not an investment. Thus, starting with a comparison between your savings and your investment is an inappropriate metric. and to and and just don't do it. Don't start there. It's not how the conversation should go. It's out of order. We're all about financial order of operations: protect, save, grow. It's protection and savings. Then there's a wall, and then we have our growth, and that growth should not be able to reach back and take any risk from the protection or savings side. It should not be a detractor to your protection and savings. And with this vehicle, it's not.
Yeah. Tell me, it's like, tell me why a cat is a better animal than a deer, and I'll tell you why it isn't. Like,
It's
the only thing that's the
awesome.
same is they're animals. Like, just like these are both financial vehicles. Other than that, they're
Yeah.
not even the same. Like, it's a stupid comparison. So I'm with you on that. It's just, that's pretty dumb. All right, let's move on to 2. I think we beat that one to death. This one kind of ties into number 1. The rate of return is terrible. Yeah,
Yeah. It's
except it's not.
compared to what?
Compared to what? But except it's not. If you're looking at, can this thing match, what the S&P has done for the last 20 years on an annualized or an average basis? No. And I don't even care about the comparisons of that. Can this thing match a 12% rate of return hard money loan over the course of the next 3 years, in the first 3 years of a policy? No. Like, it can't, and that's not even what the function of it is, because it's not an investment. So it's not getting a rate of return. But if I look at the way that these things are structured and I look at an annualized rate of return, so what that says is, we all know that in whole life insurance, if you've been listening to this, you know that the first couple years you're going to be upside down, I'm going to call it, for lack of a better term, in cash value. So maybe you paid $10,000 in total premium, and maybe you have $7,000 of cash value because there's a cost to obtaining insurance. So you're negative 3,000 cash input, cash available. And then the next year, maybe you're negative 5,000 combined between years 1 and 2. And then year 3, you're still negative 5. Year 4, that starts to flip flop, right? And at a certain point, all of the money you've paid in premium will be available in cash value. So at that point, let's say that's 7 years into the policy. I'm making this up. I mean, it's all based on how it's designed. At that point, you've hit every dollar in is available. You're at what rate of return on your money?
Yeah.
Yeah,
If
zero.
you look at
Zero. Because
right.
so it might take you 7 years if you're just comparing rates of return to get to the point where it's like, oh, my rate of return annualized is now 0. And then it has to start. So you have to overcome 7 years, in other words, just to get to 0. And then going forward, you continue analyzing the gains. And what do these things average as an annualized return? It's usually over 4 to 5% tax free,
right.
which
That's
means,
net
what's it
net
doing
of
in year
taxes.
20? Is it only doing 4% in year 20?
No. Year over
Like,
year, it's off the charts.
it's off the charts. Like, that year, it could be 45%, but it had to overcome negative 3,000% in year 1 to average
Right.
out to 4 and 5. So when you look at this, so it's like the stupidest thing, because one, it's not even the same as like investing in a market where you just start compounding on your capital. Like, we're purchasing an asset that has all these tools around it, that has privacy, that has guarantees, that has security, that has a death benefit. And it's still going to get to a point where it just about matches the long-term growth of the S&P, and year over year, it's going to far outperform it. All right. You can
Yeah.
say what you want. No, I kind of ran
It
on that one.
it feels like it feels like it's. I mean, this conversation honestly is a kind of extension of the first one. It is like too dumb of a criticism to really spend as much time on, but it's because it's so prevalent. We kind of have to. It's like if I open up my toolbox and I see a bunch of different tools in there, I don't get mad at my sandpaper for not being able to hammer a nail. Like if I take a sandpaper and I try to whack it against a nail, and then I'm like,
Put holes in
this
it.
is a terrible product. This is a terrible hammer. Like, why did I get this? Why would I buy this sandpaper when I could get a hammer? It's like, well, that you should not be managing your money at all in that case if that's how you think through it, because that just doesn't make sense, right? And so when I look at these tools, I don't look at like if we're going by the metric of what is the best rate of return, because in all situations higher number is always better, well, that's not a way to build a sound financial strategy. What is the best place you could put your money in over the last year? What, silver? Probably a meme
Probably,
coin.
yeah, right now.
Probably let's say silver. Let's say silver over the last 12 months, the best performing asset outside of a meme coin that that did a 1,000% pump and dump or whatever. Let's just say the best asset over the last 12 months was silver. Okay. Well, where should you put your money over the last 12 months? What's the best rate of return? Why would you put in the S&P 5? Why did you put in 401k when you can put it in silver? Okay, well, what about the last 2 years? Okay, it's probably gold, right? So you should. Why would you put your money in silver when you should put your money in gold? Because gold got a higher return over the last 2 years. All right, what about the last 15 years? What's the best place you could have put your money over the last 15 years? Well, Bitcoin. Why would you put your money in gold and silver when over the last 15 years, Bitcoin averaged, a 15,000% return? Why would you idiot? Why would you put your money in gold? Right? What about the last 100 years? It's like if your comparison and your measuring stick is just what got me the best, what's the best possible rate of return I could get. And again, that's measuring the past performance. If you've been in Bitcoin for 15 years, you're ecstatic. If you've been in Bitcoin for 1 year, you're despondent. You did worse. You did worse than the COVID downturn in 2020 in the market, like that March snapdown that we had. You've performed worse in Bitcoin if you've been a Bitcoin holder for 1 year. But if you've been a Bitcoin holder for 15 years, you have an unfathomable return, right? You're probably in the Bitcoin billionaire class, right? And so
Yep.
that is a dumb metric to measure by. What is the best rate of return if that's your only metric? Like, it is a metric that matters, but Dave Ramsey Inc., the financial checkers grandmaster, has you convinced when you frame this conversation that the only thing that matters is rate of return. And that's a metric, but it's not for anyone the primary metric, right? If you talk to listening to like Brett Tanner's Be Wealthy podcast, when he's talking about where am I going to invest my money, the first thing is not just that this investment gets me 25% rate of return. This investment is a 13% rate of return. Therefore, this one's better. It's what do I know? What do I understand? What can I control? What are the downsides? What risks are there? Can I manage the risks? How can I hedge against the risk? There's a whole paragraph of discussion before we get to rate of return. That is something to factor in, but it is one factor. And so in the same way, like, just to say that this is a terrible rate of return, it's like, well, the intention is not rate of return, but like you said, when we strip apart that you said it takes 7 years to quote break even. Well, I'm in year 4 of my policy, and I'm already getting in more per year over year than I'm putting in, right? So at 4 years in, I'm getting more. In 2026, I will put in X amount of dollars, and I will get greater than X in cash value growth, right? So now I'm there in 4 years. But again, by year 7, my policy is projected to quote break even. But this year and next year and the year after and year 30 and year 50, those are all positive year over year returns. Just like a business, like I'll make one more point to round this out here. If you looked at Amazon's first 10 years in business, you would say this is a terrible business. They haven't broken even, right? So the same thing that goes back to like, what's the best investment in 1 year, 2 years, 15 years? Well, Amazon is a phenomenal investment if you invested at the very beginning, right? Who wouldn't want to invest at the very beginning of Amazon? But the first 10, 15 years of Amazon was a terrible investment. And so it's not a valid metric to just say, I can get more return here, hopefully, possibly, maybe. And so therefore, I'm not going to do this.
Yeah. And to follow up on what you said there too, you ever buy dividend stocks or really studied people that build dividend portfolios?
Yeah,
one of the very first things that anybody that is actually successful in dividend stock investing, which does work, when people understand what they're doing with it, they'll almost always tell you, do not buy the dividend stocks that pay the highest returns, because they're going to fail you. If you just look for dividend stocks that are paying 10%, it looks phenomenal for this year's investment. I'm going to buy this stock, it's going to pay 10%. But why and how are they paying that much money? The safer bet is to look for ones that are paying 3-4%. And then do they have a 10% growth on their dividend per year? And have they had that 8 to 10% growth on their dividend year over year over year over year? So if you project those things out, most of the stocks that are paying 10% now falter. Their dividends fall apart, they go away, the stock price drops. Most people end up crashing and burning trying to chase the biggest dividend yield, But the people who go into the 3 and 4% ones that have dividend growth in 20 years, they're kicking off some real cash. And it's the same idea. Like if you just look for rate of return, you're going to fail at this investing model. Anyway.
Right. And those guys, if you went to the dividend investor and you said, hey, why would you put your money in a dividend stock when you could put your money in silver over the last year, when you could put your money in gold over the last 2 years? They would say, well, the reason I would buy gold or silver is different than just rate of return. Like gold and silver investors don't buy it just to make dollars. They buy it to transport the value over time through an inflationary environment. They transport value over time with metals. So they would be like, yeah, I mean, talk to like Peter Schiff and people that have been pushing this, saying this for 10 years, and people have laughed at them. Well, now they're taking their victory lap, but also they're kind of like, I mean, yeah, I was right. I knew I was right. I knew that this was coming, but it's not necessarily a good thing because now I have more dollars. But what does that say about the dollars? It just means the dollar does less now, right? So the goal of a metal investor is to transport value through time, not just acquire more dollars. The goal of a dividend stock investor is to generate cash flow to support life now. So yeah, could you make more money if you put it into an ETF and let it sit and marinate for 40 years in your 401k? Yes, but your goal is cash flow. So it doesn't achieve that goal. It's a sandpaper or a level or a tape measure, but it's not the hammer you're looking for. And the financial media is just about finding a hammer. Like every tool is a hammer. Everything you're looking for is rate of return. If that's your primary and only metric, then you're just not doing it right, in our opinion.
Yeah. All right. So the next one is again, these are just like piggybacking off each other because I feel like we've already covered half of this topic, but the next objection is you don't break even for years. And I'll first hit that. I mean, we don't have to talk too long on this one because we've already hit it all, but a lot of times when people think that, or if you listen to someone like the financial entertainers like Dave Ramsey talk about this, he'll get all high and mighty and higher on his horse and he'll say, it takes you 17 years just to get your money, and the cash value. So if I do get a standard vanilla stock mutual or non-mutual stock company whole life insurance policy, it will take 15 to 17 years until the cash value in the policy equals the total amount of premiums paid. True. Can't argue that. You don't break even for years. However, the way we talk about this, we're designing it in a specific way to be utilized for this banking function. And in those first couple years, so ours typically break even, I'd say 7-ish. That's a pretty decent guesstimate. So they're all a little different. Age, goals, like every policy is a little different. So let's call it 7 to 10 years. There's things that are happening. Hans already hit on it. It's like starting a business. The business costs money to start. So there's probably a term component to your policy. Maybe not. There's going to be policy fees. The company has to pay to do the underwriting. They have to pay the paramedicals. They have to pay to set this up. The company has a staff. The company has actuaries. The company has, people that do the investment portfolios to make sure that they're profitable. It has buildings. They have to pay for that stuff in order to put these things in force that we're going to use and are going to benefit our family for the rest of our life. That costs money, which means the company has to make money. The agents, Hans, me, whoever you work with, we get paid to do what we do. So they're going to pay us a commission. All of those things happen in the beginning for the most part. And if you think about it, if you look at the company's perspective, if you take out a policy today and you die tomorrow and you only paid one monthly fee, what you do, you paid a monthly premium, you paid $1,000 and you have a death benefit of 1.3 million, is the company going to pay it? The death benefit. Yes. Yeah. So when is the company, when is the highest level of risk for a new policyholder to the company?
Year one, after you pay your first
premium. Earliest point. Because you could live one day past your initial payment and they have to pay the entire death benefit. So naturally, a lot of those fees are going to be front loaded. Like they want to cover the cost of what it costs them to put this thing in force. Their business expenses surrounding the policy have to be covered first. And then the ongoing premiums, they're still going to have that within their economy to do things with. So, but when you think of this as buying an asset and buying a business, it makes total sense that you're upside down in the first couple of years. Like you can't this can't be free to you. It's a service and an asset and something that's going to pay a massive death benefit down the road. All right.
Yeah.
There's my side.
Yeah. I mean, the idea, so this going back to this is the break even, like how it takes a long time to break even was the point. Irrelevant, honestly,
It is.
because of how we use it. If you're looking at your 401k, you don't say, what is my return in year one? You don't really think about it. Now, in reality, a lot of people hawk it and get nervous and make changes and make bad decisions and go in and buy high and sell low, right? People make bad decisions, but notionally, or you're supposed to be not looking at your 401k for 30 years because you can't touch it anyways. And so that same thing, the same person who says, well, why would I put money into whole life when I could put it into 401k? They'll say, that same person will say, well, yeah, look how long it takes you to break even on this. And it's like, all right, well, let's fast forward to 30 years from down the road. Where are you going to be at? You don't know. You have no idea. Where am I going to be at? I can tell you exactly where I'm going to be at. And so the
Yeah.
other thing is, when I do, so like I said, I'm 4 years into my policy. I'm at the point where I'm what we might call cash on cash. I put $1 in, I get more than $1 in cash value. That happened in 4 years. That's quick, even for just about any business, right? That's quick. I'm already there, but like you said, I'm about 7 years is when my total cash value will surpass my total premium, right? And then it's going to keep that delta is going to keep growing, but I'm not there yet. So I quote haven't broken even on my policy. But if you've done a call with me, an intro call or a strategy call, I've walked you through a visualization of policy loans, and I use my actual policy with the actual number I pay, the percentage of that goes to PUA, the percentage that goes to base, and I show what I've actually done with the investments that have been funded from my cash value via policy loans. I'm at 5 right now. Real estate syndicate, 3 rental properties, and a loan that I use to invest in my low stress trading options brokerage account, right? So I go through and I say, all right, here's my total outstanding policy loan. I mentioned it, I think, last week. I got about $120,000 outstanding policy loan, and I'm generating an amount of interest on that each year. That interest that I generate is how I calculate my total cost of borrowing. How did I get $120,000 to work for me? It cost me X amount each year. And then I compare that to what these 5 investments are bringing in revenue. I take the total revenue divided by the interest cost, and that's my percent return. And it's around 5x, right? So I'm making in my investments relative to the cost of getting that money, the cost of accessing OPM, other people's money, in this case, the insurance company's money, I'm making about a 500% return over the cost of my capital, right? Again, total revenue from all these investment sources divided by the total cost of interest, it equals, for every dollar I pay the company in interest, I'm making about 5 for my investments. Okay. I'll put that up when you're talking about, this is a bad investment. I'll put that up against your investments all day long. I don't care what you're doing. You're not beating me there, right? Unless you're doing IBC, unless you're being a banker, you're not beating me there. But I go through this, I draw it all out. Now, no one has ever once told me, yeah, Hans, that looks cool. I like the idea of making 500% return on the interest that I'm accumulating and paying to the company on the investments that I'm using that cash value to generate. But as good as that looks, you're telling me you're not broke, you haven't broke even on your cash value relative to your premium input? Well, no, because that's a second conversation we have after we go through a breakdown of how premium is structured. What is the base? How does it grow? How does it generate death benefit? How does it generate cash value? Those are the same cash value and death benefit, the same things, just at different times in the timeline, right? Same thing with PUA. How does it generate death benefit? How does it grow in cash value, right? Once you understand those two mechanics, it makes sense why I say that I've put in my amount of premium for the year, but only 70% of that is available in year one as cash value. No one's ever said, well, okay, that's great, but the other 30%, where I want to put that somewhere where I can immediately access the entire 100% of what I put in. It's a misunderstanding of the application. That is not a challenge that anyone has when they understand premium mechanics and they understand how to use a policy loan to go then do these investments. They all say that's really cool. They never say, but you haven't broken even yet. And I'm about 3 years from breaking even. But you know what? That first investment I did was 6 months into my policy. It wasn't even a year in, and I already had an investment that was generating a much higher return than the interest that capital is accruing. And so, yes, I have not, quote, broken even. Does it matter? Not in the slightest.
All right. And that actually kind of leads, since you mentioned OP, that kind of leads to objections 4 and 5, which are intimately tied together. One is, and this is the way it typically comes out in question, but you got to separate into two thoughts. Why would I pay interest to borrow my own money? And so there's two fundamental problems with that question. Why would I pay interest and then borrow my own money? You've kind of touched on the borrow my own money. So let's start there. And it's very simple. We don't have to go in depth on it because mechanically it works like this. The insurance company has issued or come to an agreement with you and offered you this contract. The insurance company is going to house and take care of, and they're going to uphold the contract and do all their part of that. One of those contract provisions is you have the right to access the cash value or the equity of the policy. When you borrow the money, the company is not loaning you your money. You don't actually have cash in your policy. That's just not there. It's considered capital, and it's just the inherent value of what your current death benefit, or what, the current value of your future death benefit is. So it's a capital equivalency, if you'll, or it is capital, but it's a cash equivalency is the word I was looking for there, in the form of capital that is promised via that contract. So because you have access to that and it has this certain value, the company says, oh, his policy has a certain amount of value. We'll use it as collateral, put a lien against that, and loan that policy owner our money because we have the perfect collateral in the policy. So you're never, ever, ever borrowing your own money. You're always borrowing the insurance company's money, and they're using your capital as leverage or as collateral for that money they're loaning you. And they're going to charge you interest. So that's the first misconception people have. Why would I pay interest to borrow my own money? You're never borrowing your own money. You're borrowing the insurance company's money. And as long as that's clear, I'll let you run with the interest part and why it would make sense to pay interest on that.
When I hear that question, I think in my mind, you say, why would you pay, why would you pay interest to borrow your own money? As you just defined, you're not. But flip that question. Why would you pay interest to borrow someone else's money? Because what does that give them? Control of the terms, control of the repayment, the ability to recall the asset if you don't make those payments, right? You give them full control when you borrow someone else's money. Now, again, we're not borrowing our own money, but we're getting these terms by borrowing the insurance company's money. This is, again, the nature of the policy loan, the right that you have within the contract to get a unscheduled, or unamortized loan against your cash value. That right that you have is the most powerful lending tool that you could possibly have, right?
Yeah, and I believe the contractual phraseology, I'm going off the top of my head, it says something like, you can pay this back at any time you want. I'm going to put it in my own English, but there's one sentence within the contract that says you can pay it back. You have the right to pay this back, this interest and lien back at any time. And period. It's like super simple. But because it's just one sentence that says that basically what it says is like, oh, I don't have to? Oh, you mean I can do it when I want, how I want? It's awesome.
Exactly. And so that's, so you just answered the question. Why would I pay money why would I pay interest to borrow my own money? Again, not your own money, but why would I pay money to borrow against my cash value? For that reason, for exactly what you just said, because I can control it, because I don't have to pay it back. I should. Again, we're always going to say you should pay back your loans, be a good banker, but I'm in control. I want to be in control of the terms. So for the exact reason that you're saying it's a bad thing to quote, borrow my own money, is actually the reason that I want to borrow my own money, not my own money again, but just using your terms. That's exactly why, because I want control. I want the ability to repay. And when I pay to borrow, like if I take these two comparisons, even if the loans were exactly the same, right? Even if they required repayment, if the company said, we're going to, whatever rates you can find out in town at the car dealer or whatever, we're going to give you the same terms. We're going to make you repay, which again, they're not going to. So that is why I borrow my own money, quote. But even if they did, if I put these two loans side by side, think what happens when I make that payment. If I set my repayment exactly on par with what I would pay the dealer, $800 a month to the dealer for the car, $800 a month to the insurance company for the policy loan, right? Well, in one situation, I own the car outright. The dealership can't possess it, so that's nice. That's another reason why I would pay to borrow my own money. But when I make those payments, to the company or to the insurance the dealership, that $800, let's just say it's amortized where 650 is principal and 150 of that is interest, right? Well, when I make that payment, zero of it goes to increasing the balance of one of my savings accounts. $0 out of 800 improve my life other than releasing me from $800 worth of a lien against my vehicle, right? So I guess you could look at that as I'm putting $800 into my car. That's $800 fewer that they have claim over. But again, if I don't make my payments, they're just going to repossess the car and sell it and give me the difference. So in that event, I did, in the event that they repossess my car, sell it at auction, pay themselves back, and then give me the remainder, that remainder for me is now $800 higher, or actually $650 higher, because the interest doesn't go to me either, right? In the example, if I give myself the $800 payment to the insurance company, one, nobody can repossess my car, whether or not I pay my loan. So again, that's why I would pay interest to borrow my own money. But in that event, I'm paying the 150 to the company in the form of interest. And yes, I'm enriching the company that I own and gives me dividends. So I'm happy about that. That's why I would pay interest to borrow my own money. But the other part of it, the 650 that goes towards the principal, again, this is not precise with how policy loan mechanics and repayments work, but just to keep the analogy as close as possible, to make the policy loan as bad as a regular loan, I'll say that only 650 of my 800 goes to principal. Well, that 650, rather than going to the amount of money I would get if they repossessed my car, sold it, made it themselves whole at auction, and then gave me the difference, instead, that amount of money goes right back into freeing up the lien on my cash value. So on my screen, on my policyholder portal, it goes from, say, whatever 10,000 is that I can borrow against. Now it says $10,650. I've increased my cash value that I can access again because I didn't dip into it. It didn't deplete, but I did put a little lien on it, and I released that lien. So if I view my cash value as my savings, which I do, I just threw $650 back into my savings. So again, that is why I would, even though you mean that as a slight, as a criticism, why would I pay interest to borrow my own money? Well, why would you pay interest to borrow someone else's money and give them full terms, and every dollar that goes to them goes entirely to enriching them and provides you zero value? Like it actually is a selling point to me.
We love being slaves. That's why.
Right. Yeah. It's actually one. I think that I'll give the benefit of the doubt that whenever someone says that, they don't understand a policy loan. If anyone understands the mechanics of a policy loan, they would never say that, because the answer is always, of course, I would rather pay interest to borrow my own money. Quote, right? Of course, I would rather do that. It's stupid not to.
And like what I've said to folks is as a silly example, if you pay an extra $1,500 to, I don't know, PNC Bank or Bank of America for your car loan, and then the day after that check clears, your hot water tank blows, and you call them up and you're like, "Hey, bro, I paid an extra $1,500 yesterday, and I just had an emergency. Can I get that back?" What, is there any chance they'd give it back to you?
Not in a million years.
Not in a million years. They might offer you another loan, a personal loan at 20% interest for your emergency need, but that's about the best you're going to do. If you just paid that extra $1,500 to your policy loan and your hot water tank blows and you have to get a new one, can you just get it right back out?
Yep, it is right.
Any
there
questions asked?
Contractually guaranteed.
It's back in your warehouse of wealth. Like, so I would always rather do that. And if I have to pay a little bit of interest to do that, that's great. And the second thing, the last thing I'll say about it is, what episode was it? I had just had it up here. Episode 78. I did that solo episode on EVA, economic value added. Yeah. And I think if you don't understand what that means, you should go back and listen to that one. I'm not going to preach on it, but the question is, do you value Bank of America's money at a higher level than you value your own? Is their money worth more to you than your money's worth to you? And if you don't understand that principle, go back and listen to that episode, and I think it will help. Like, you're willing to utilize your money for free and make no rate of return, back to that, on your own money, but you'll pay the Bank of America a rate of return to access their money. Their money must be more valuable than your own in your eyes. Yeah. So go back and listen to that one if that doesn't make sense to you.
Yeah, and I think I said that, I think I made it sound like it would be stupid to borrow anyone else's money rather than my own, quote. But what I meant is, it would be stupid to think that that is always superior. Like, there are, of course, you ask Yeah, you add like most investors borrow money from somebody else. Most
Yep.
successful people, almost everyone borrows money from someone else. So I'm not saying that borrowing from someone else is stupid. I'm saying the challenge is stupid because it implies you don't understand the policy loan and how much superior it is, but it doesn't. I'm not saying that that's the right use in all instances, right? If I can make a lot more money investing my cash value, right, by using a policy loan to invest somewhere else, it might very well make sense for me to take out a car loan from the dealership. But understanding is key here, and when you understand it, this challenge falls flat. And not only does it fall flat, it actually proves the opposite, in my opinion.
Yeah. All right. Ready to move on?
Yep.
Objection 6. The agent makes huge commissions.
All right, here's what I told. Here's our boy Flyby LLC on YouTube. I found the comments at Flyby, two Y's and fly, two Y's. So fly, two Y's, by BYY LLC. I don't think he's listening, but if he is, Flyby LLC. That's another. What you said was you would buy term and invest the difference, and by the time you're 65, you'll have hundreds of thousands or millions in coverage / tax-free income. Okay, well, maybe. There's a lot of maybes in there, and I don't really understand where buy term and invest the difference gets you that tax-free income. But it's also not income. You should learn the definition of income versus capital gains and liquidating assets for a capital gain vice income. It's not tax-free income, but more importantly to this bullet point, he says come to an agent that actually cares about you and doesn't just sell what pays the highest commission. Okay, term pays the highest commission because it's the easiest to sell, and IULs as well. Like of the life insurance policies products, whole life is the hardest to sell because of retarded marketing like this and people like Dave Ramsey who are a net negative on the financial landscape of most Americans except for like poor people, I would say. Uh the the hardest to sell is whole life because there are so many misconceptions as we are dismantling in this episode. But also it if you compare it to like go ask your asset manager, go ask your CFP if they would trade, say, hey, I would like to do business with you. I just want to buy some term and invest the difference. I'm going to invest the difference with you, but I will only do so if you swap out your compensation plan for a whole life agent's compensation plan. I want you to get paid. So rather than taking a 1% AUM fee, I would rather you get the whole life insurance agent compensation model where you get paid for year one value. Well, they would not a single one would take that because they're going to take a drastic pay cut. If we could take 1% of your cash value somehow as compensation for the life of your policy, would we take that? I mean, if it doesn't hurt you and we get much richer by doing a 1% AUM fee, yeah, of course I would take that. That's way more money. There's a reason this is a small industry and the CFP is a very large, flashy industry. Not the CFP, that's the financial planning industry, is because like those Goldman Sachs has a much larger, building and skyscraper than a whole life insurer. Right now, whole life insurers are very strong financially, but you don't get into the whole life agent business because of the huge commissions. We get paid well, we provide value, but I guarantee you're not going to find a single financial advisor who would switch compensation models with us because that's
No,
just another one that shows you don't understand what you're talking about.
yeah. I mean, but when we do get paid, we make a decent amount of money up front for the, like you said, the
Yeah.
first year on these policies. But I can tell you that I have had probably 150 people that I know in my circle who know that we're in the financial world. People, and they'll be like, "Hey, like, let's talk about like what I can do with my money." And I say, I've got a very specific niche. I teach people how to overcome the banking function in their life, and it deals almost exclusively with whole life insurance. And when people have come to me and said, like, let's chat about like how we can manage my money, how many of those people do you think have done business with me? Like two,
Yeah.
because they were looking for a place to park their money in the market. In other words, I probably could have 100 clients because it's just there's no friction there because it's all they've ever heard about is, hey, let's get my money into these funds and do this. It is so much easier to get a client as a typical financial advisor than it is in the whole life realm. When we're telling people that they should pay a high level premium with respect to their income and change their lifestyle around this strategy. Like that
Yeah.
is a hard sell. So I am not doing it for commissions, because if I was only wanting to make money off of your money, I'd go get a securities license, and then I'd go to some
Absolutely.
broker dealer and I would put your money in their mutual funds. And every time it went wrong, I would say, you just got to wait out the market. You don't lose anything till you sell. Just stay the course. And then I'd hang up the phone and I'd call the next guy. That would
Yeah.
be so much easier.
Yeah,
Yeah.
you just need a securities license to be a quote financial advisor. You don't need a CFP. That's just training. That's just a
Yeah.
thing you can put behind your name. Those are letters you can put behind your name. There's value there. I think it is good. But
I do
but
too. And I'm not even
we
knocking
could
people to do that.
yeah, I've looked into getting my doing like the Series 66 and getting my securities license just because people assign value to it. I wouldn't do that as an asset manager and be like, hey, not only can I do your life insurance, I can also manage your assets. I wouldn't do that still because that's not my lane. I'm a one trick pony here. But
Yeah. I wouldn't do it
you know,
because of the compliance on this podcast. We wouldn't be able to say
like
shit.
right. The at an industry like a life insurance event or an industry event that I was at, all these events have sponsors, and one of them was an investment management firm, right? And what they want you to do is, and this is no like these aren't like these are good people that do a good business. So it's not like, again, this is to counter the idea that we're doing this because like I'm trying to sell you whole life because that's how I get paid the most. It's not. It's definitely not. I could have 4 years ago just gotten my securities license. I'd be making way, way more money because I have that. People are much more interested in that conversation, like you said. If someone's like, "Hey, how do I get rich quick? How do I?" You're like, "I'm looking at rate of return. What's my most rate of return?" I'm like, "Actually, let's save money in a boring, structured contract with guarantees. Let's just save your money, right? Like we would make a lot more money if we went securities license and did the investment advisor routes. But that was the pitch that these guys gave. And again, I'm not knocking. These are not bad guys. Like they're trying to help you build out your business because it is such a lucrative business. They say, hey, listen, the average insurance client has an X, net worth of X, right? And so they've got Y amount of investable assets. If you, as their insurance agent, can basically get them to bring their business over with you, bring their assets over to your management, and you get the 1% management fee. On average, you only need about 25 of your insurance clients to do that before you can generate easily 6 figures a year in passive income just from the management fee. We do the management, we do the funds. All you have to do is get them to bring their money over to you as the investment advisor. You tap into our funds. Once you hit $1 million assets under management, you're off to the races. It doesn't take too much before this starts compounding. And look what 1% a year does of assets under management as you grow this portfolio. So
Yes,
the
10 grand
whole
right there.
idea, it's amazing. I mean, it is a very compelling. Like they gave me a book. They're like, hey, it's not hard. Like their pitch. This is the funny thing. The whole value of this pitch was, hey, look how easy. It's not hard to get your securities license. Like you've got enough of the knowledge. You just need to pass a few tests. You do some basic coursework. All of a sudden, you now get to tell your clients, hey, not only am I your insurance guy, but also bring your assets over. Now you get 1% under management. You'll be making hundreds of thousands of dollars just in that 1% every year. No guarantee. Because once people park it, they don't leave. The hard part is getting people to park it with you. Once it's parked, they don't leave. So if you got some young guys, you got some young, your client base are around your age, they're starting to look at things for their families. Like if you can get that money now, you're going to be making gravy in no time. And I'm not going that route because again, I don't want to be your investment advisor. I don't want to be your financial advisor. I don't want to be picking your funds for you because I don't trust the market. Like I think a lot of stuff is coming down the pipe and I don't want to be in that position of you paying me regardless of my performance. You pay me when you sign up for a policy, you get exactly the policy that we sit down and we go through many, many calls. We look at different options. You get the cash value growth, the guarantees, the non-guaranteed. Like you get that, you get everything we walk through in a policy. That is what you get when you sign a contract. I do get paid. That's part of the company's expenses. And I get paid well. But I don't get paid anywhere near assets under management well. And I'm not trying to be. But again, the pitch of these guys is that it's so easy for you to do this and you'll make so much more money. So why would you not tack this on to your toolbox? And inversely, that's why we have situations like we had the Northwestern Mutual advisor who said, oh yeah, I can do life insurance. I've heard of IBC. I can do that. And got the client into the totally wrong products and got the children in the VULs and gave the parents policies with no PUA riders, like nothing that we're trying to do. And so
Yep.
you should not mix these here. But the idea that, like, I mean, one, you have to be anti-capitalist to really worry about how much someone's getting paid if you provide the service. Is like you take out a mortgage. Part of the whole thing is like, here's what your realtors are going to get paid: 3% to the selling, 3% to the buyer. Like, you can negotiate those down, but once you sign the contract, it's like you didn't lose money. Like, you got exactly what you paid for. You got the house, you got on the terms that you agreed to. It's like it's just a financial transaction. So it's a dumb challenge to begin with. But even then,
Yeah.
it's like, within the industry, relative to our peers in the financial services realm, it falls flat pretty quick.
Yeah. And on the other YouTube channel, when I did the overview of this, one thing I said that I want to cap this objection off with is, do you make financial decisions based on like what somebody else earns, or do you do it based on whether that strategy has merit and serves you? You know, so for the people that are in 401ks and who've made a lot of money, like, are they mad that the advisor is getting 1% annually? Does that make, just because they're getting paid, is it a scam? So, yeah, judge a strategy not on what somebody gets paid delivering it to you, but whether judge it on what it delivers, on what you get, what that strategy. I can't speak. Judge it on what strategy or what that strategy delivers to you. Man, I had trouble spitting that out.
Well, and remember, in past,
You know,
we pulled up a calculator.
one of our old mentors used to always say, like, if I could, if I guarantee that I can bring $1 million into your life, would you get upset if a third party paid me $1 million?
Yeah,
Like, well, no.
any amount doesn't matter.
Yeah.
Like, why? Yeah, but we've shown in a past episode a projection of like, all right, if your investments do X, so you put in the rate of return calculator. If I get an average rate of return of 8%, which again is a fallacy, but we say that here's your mountain of growth. When you're 65 and 30 years, here's the number you'll have. And when we go into the variables in the calculator and we put management fee 1%, that number drops down by about a third. So if you look at that number and you see that you have $3 million of at the end of this, getting an average rate of return of 8% a year, whatever that number is, whatever the average rate of return you put in as an input, spits out that number at age 65, that bucket you're going to live off of when you just start withdrawing 4%, whatever. That 1%, if that number is $3 million, you're giving your advisor about $1 million.
Yeah.
Now, that's okay. Like, that's not a bad thing, but you need to understand that, and that is not well laid out when you have these conversations. I guarantee, I can tell you that.
I'm only going to take just a small 1%. I actually had a guy tell me that one time, just 1.25%. And once you have 350,000, I'll lower it to 1%. That's it. That's it. Not much, just 1%. Yeah. Okay. Anyway,
there's some financial, there's some wizardry out there, and calculators can really, really make a pig look shiny and clean. But
yeah. But fortunately, on our end of it, we can also reveal the dirt sometimes.
Yep.
Objection number 7. This one's pretty easy. I don't think we need to spend a lot of time here at all. This only works if you're rich. And I'll say that if you're poor, you're really the first thing is figure out a way to make more income if you can, if you're young and able and capable and all those things. And it's not a big life issue. But if you're generating income, you need to save some money. Like, we're in the richest nation in the world with one of the lowest savings rates for as rich as we are. You need to save money. So if you can save 5%, 10%, start saving. That saving should equal your premium. Save it in the form of premium to a policy. Now there is a certain amount that it's going to be hard to use less than as an adult, but my kids' policies are $100 a month. The first ones I did for them when I very first started IBC, not a lot of money, $1,200 a year that I saved for them. At this point now, I put $1,200 in. It's kicking out $1,800, a year, like what we talked about earlier. So it works on a small level for them. I'd say for adults, I think probably my smallest policy is would break down to about a $400 a year premium. That includes the base, the PUA, the full structure. So you don't have to be rich to be able to afford. That's $4,800 a year. We could do them smaller. We just, fortunately, we've had people that were able to save a little bit more, but we've also got people on the other end of that pay really large amounts of premium, even into the
400 a month. You meant, you said 400 a year, 400 a month.
Yeah, $400 a month. Thank you.
Yeah.
So I think that's probably among my smallest adult policies, but you don't have to be wealthy to save $400 a month. You just have to be willing to save some money, and it's all based on income. It's all relative to income. So, that person might not have been able to afford 10 or $1,000 a month, and that's okay. But they did it. They started, and they're doing great with this. Like, it's just stupid to think like, well, I got to be rich. I can't do it. I'm just going to turn away. That's what everybody says.
Yeah,
Like,
you
if you
just
don't
got a
start,
policy
it's
on what is it, 18 or 20-year-old? A couple
yeah,
kids in your local area recently that you put policies on that are working. They're not getting their
yeah,
policies paid for them, but they're paying for their own policies out of work. Like they're not
great.
rich. They're just working teenagers. Like, I'll,
It's
you know,
awesome, and it's so exciting to do that.
yeah. I mean, I like, if we look at the person who's saying this, I mean, I'm just assuming this is all Flyby LLC because I'm looking at the screen. This is who I'm picturing, whoever that is. But relative to Flyby LLC, like I'm probably within a standard deviation of whoever that is, right? Like I'm not like rich by my, in my mind, like I'm good. I got everything I need. I'm growing, doing really well, but like I'm not like the wealthy, right? But when I was an officer in the military, you know exactly how much I'm making as an O4 in the military, O3 in the military. You know exactly
Yeah,
how much I'm making. I was paying $50,000 a year in premium on my policy, and that is a good, healthy policy. That's it's an aggressive policy, but I have a good savings habit, and I can do that, and I can sustain that, and so I understand the value of it. So it's relative to my knowledge and my income, but it doesn't mean that you have to be rich to do this. Like if you have a really high, I got a construction worker, um, pretty good, decent income, like not great income, but not off the charts, but he has no debt, no bills, like owns this like very, very well established savings habit. So I was like, man, looking at your numbers here with what we're doing, I mean, you could put 75% of your income into this and still have a exact same comfortable living because he's saving so much money. He could do a larger policy than someone that makes 200 grand a year and spends it all or spends most of it, right? So it's totally relative to the individual, and I don't think much more is needed on this one. It's just that's another.
oh yeah. I guess that's an easy one. The next one we could go in depth, and we're at an hour, so it's buy term and invest the difference. And I have a feeling that one's going to be a 20-minute rant from either
Yeah.
one of us. So I don't know that I want to dive into that. Would you think you want to make this a part 2? There's only 3 left, but we could probably talk enough on that one. Objection 9 is this sounds too good to be true. Objection 10 is only life insurance salesmen promote this.
All right. Those are good. Yeah, I think that's a good part 2 because
Yeah, let's make this a
really
part 2.
load up. Yeah. All right. This will be a part 2. There may be a special guest release between part 1 and part 2 that I'm pretty excited about, an upcoming interview. So these may not be in order, but they may be in order. We'll see. But yeah, I think that's a good place to call it because there's a lot to say about buy term and invest the difference. That's another thing that my boy Flyby LLC said was the standard, like the gold standard of what you should be doing. Because guys, if you just buy term and invest the difference, by the time you're 65,
we got an episode coming. Hold it. That's next episode.
Well, I'm just going to queue it up. I'm going to queue up. I'll leave with this. I'll leave it with this comment right here.
I was like, I know how easy it is to travel down this. That's why I wanted to wait. I was like, it'll just get us going.
I know. Well, I'm going to read his and leave it with that.
Nail it, dude.
If you buy term and invest the difference, according to Flyby LLC, by the time you're 65, don't know how old he is. He doesn't know how old the person he's talking to is. But by the time you're 65, you'll have hundreds of thousands - millions in coverage / tax-free income. Guys, what are we even doing talking about whole life insurance if we could get hundreds of thousands - millions of coverage / tax-free income? Like, I'm sold. We'll talk about that next time.
Yeah, let's break that down next week.
All right,
brother.
Right,
please,
cool.
if you're getting any value from this, we ask that you please subscribe, run back to episode 78, and also check out the other channel at Brian R. Moody. We'd love it if you'd subscribe to that as well and watch through those first couple videos beginning to end. I would greatly appreciate that just to help drive in traffic to us. That would be super helpful. Thanks, guys. Appreciate it. See you, Hans.
All right, cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.